Okay, welcome to Tapping Oil, Thursday, July 5th. So, looks like a good start so far. Everything's sitting in the middle. So, now I'll let Richard continue his questions to me here.
Okay, so Rick, years ago I was trading crude oil options, mostly strangles, similar to what you're doing now. Unfortunately, the market just started moving big time, and volatility came into it that inflated all my short positions and went against me, and I lost a good bit of money and had to eventually get out. Well, I'd like to get back in now, a little more circumspectly, hopefully, and I'm wanting to study what you're doing and possibly do the same type of trades. So my questions were, firstly, what I understand is you go in with several contracts, maybe, I can't remember, 3, 4, 5, 6, and
Four.
as 4, okay. You start, as you have one side that starts to be threatened, and you start taking off a few of those. I think the first of them at, was it 1 1/4 times what? 1.5. Okay, so it's 1.5, 1 3/4, and then 2 times. Is that correct?
Yeah, correct. A third, a third, and a third.
Okay.
Or you could do it at 125, 150, 175, and 2. Depending on what you want to, what you're comfortable with. 120 to 125 can come fairly simple because this trade years had been up to I think 139. That was last week, and right now today it's 93. What I brought in, and the put side, which was down to like 0.7 of what I 30% down from what I got for it, is now up to 108 just because this new swing down to 70, 74.
Right. So yeah, it's going to go back and forth like that, and yeah, I think what you have here is good. 1.5, 1.75, 2.0. Now, when you do that, of course, if you're not adding longs, you're starting to add some negative or some naked positions. So if you have margin space, it's probably not a problem. But what if it keeps moving and your relocated shorts suddenly now they start to be threatened at the same ratios?
Mm-hmm.
Do you continue to buy back and double down on those?
Correct.
Adding more. Yeah. Okay. Does that get a little bit nasty?
It can, but you can do usually in the four unit tranche situation. You can usually get by with about 3 times, and you'll still only be about a 30. An advertised $30,000 margin.
Mm.
Okay, but you can in your set up a trading plan, try it. Maybe you want to do after you've rolled up everything once. The second time, maybe you just, instead of rolling up, you bite the bullet and take the loss, and then look for a re-entry point to re-enter and go to your larger units. And you can do that on the first pass too. In other words,
yeah.
when it hits 1.15, you just close out a third, When it hits 7.5, you close out another third, and then when it doubled, then you close out the second one, and then you, you have to, kind of be able to read the market when it's hopefully when it's going to turn. When you see it's going to turn, then you sit there and you go in there and you buy, in effect, all eight, since you're doubling it up. So yeah, you get so you, instead of buying 2 to 4 each time, you actually end up going to six, third. So yeah, 1 to 2. So you got 2 to 4 and 4 and 4. Well, actually, it's going to be, if you got easy calculation. Well, you got a 3 lot. So you buy 1. So now you're up to 2, then 4. So now you got a total of 6. So when you go, if you do it that way and go back in again, then you just sell 6 at that one price. Or you could, there's all sorts of ways to do it. And I can't, not knowing your, what you got in the account, what your confidence level is in that, if it's going to be in effect a feasible deal for you. It's something that you got to play with and get yourself comfortable with. So that's one nice thing about oil, is you can sit here and do one contract.
And that's how I'm thinking I'm going to start. It's just one contract.
Yeah, do one contract. Then you when say that gets to 175, you make a choice there. So you roll that up. Now you got 2 contracts of it.
Right.
And that way, but just simply because if you make a penny, no, yeah, I think if you make a penny, you still end up making a $3 profit. Counting your in and out charges for brokerage houses, which is something you can't do with a regular stock.
You lost me a little bit on that. If you make a penny, say it again now.
A penny. If you do a penny, you make $10. Okay, say you got $3 in and $3 out, so it costs you $6. So you made 10. You subtract the 6 from the 10, you made $4.
Okay.
And that you can't do that with a regular, stock option.
Right.
So that's a nice thing about this futures in general, is that you can make money, and you don't have to have the margin risk, because if you're doing one lot and you want to have it, naked, you're going to have, on a one lot, you're probably going to have maybe a $3,000 to $4,000 margin.
Okay.
Because I know I'm getting the 4 that I had, that was 7. And then when I added the 2 naked in the centers there, that took it up to 9. So that,
okay.
So you're running on span margin instead of what the stock market margin is too. So it's a better margining rate.
Right. It's much more favorable. I understand that. Yeah. So, all right. So in this scenario, if I just had one contract, one put, one call, let's say the call gets threatened, that comes up to 1.75, and I would buy that back for 1.75. Then I would go out far enough to find
if I go out far enough that you can sell to make
Yeah.
you lost the dollar, the 175 that you lost. So you want to get, maybe you'll get 180, you'll get 180. So you made back what you lost, and you added a little more onto it, and
Okay.
so you're still, so you've got the original profit potential plus a little bit more. You're not,
Right.
the ideal situation would be you go out there and double it, and then you get to add another 3 or 4 thousand bucks.
Yeah. So, but at the same time, though, the delta on that, when you're threatened and your price goes up to 1.75, let's say, your delta might be up to, I don't know, you know better than I, but let's say it's up to 40%, okay, 0.40. If you go out on a cost basis like what you're talking about and look for two of them that will net you the same, your total overall delta probably is
It's going to be
still kind of, yeah.
going to be hit, yes. Mainly somewhat because the put side has gone down, so you're losing deltas there, and then you've just rolled up. Now you're increasing deltas, so you got a double whammy on that deal. So your deltas will get way out of whack. I mean, I've had occasions where I've had a minus. Well, actually, that would be a positive delta. 6,000-7,000, just simply because my put side is declined in value, so the delta's gone down, and I've increased the number of calls that I had, and so the deltas have gone up just simply because of that. So you're um,
So you have a huge negative delta.
you can have a large delta, yeah.
Yeah, and is that not a little scary?
Not really. I mean, I'm basically, I'm looking at the part that I guess basically I shouldn't really be looking at, and that's kind of price and what the potential is. I'm not, I can't say 99% of the time I'm in a delta, I'm within a plus or minus 2,000 deltas. I mean, just like this, what you got up here last week, I think it was up to 1,500 in on the negative side. Now it's down to 196. So I mean, delta's going to move around. It's something that you're trying to keep. The main thing I'm trying to do is keep it under the tent. This area here. So that's why you roll it out. You extend the tent out. And so as long as it's under the tent, and if it comes back, so it's going to be over here, but the shorts are going to be over here by then. So you're still under the tent, but you're on the negative side, and you're losing. You could probably are going to be losing money, and you're just waiting for the time decay to come in. That's going to come in. If it stays there, it will eventually come up to where you're making a profit. That's we're playing a waiting game on expecting your income to come in off a time decay.
Yeah.
Movement is something. Movement is something you have to live with. It's just
right. You have to live with the risk.
Yeah. The hard part is when it's way up here, when it's down here in the center, and you're making scads of money, but you're over here, and they only say in this area here, and you're down here like you're right now. This says $1,030, $1,000, but your potential is like $10,000 if you held it to expiration.
Yeah.
just because it's in effect closer to the at the money option price, the market makers and all, they've added more premium to it, where you don't have the existing premium when you come in here, even at the money, because now uh, things are where you were, where your short strikes are, and where the at the money is further apart. You know, I've made a couple of rolls that I ended up, just finally held off as long as I could on a couple of them, and rolled up, rolled them up, and then luckily the market turned the next, roughly in the next day it started to turn. The second day it even added to it, to the spot that what I had rolled up added onto the trade is now down in the spot to where I made money I made my goal.
Yeah.
That can happen that way. And there's multiple ways of doing that. Instead of closing out, if you're close to one of these guys to your short, and you're not in the money yet, and you go out here and you sell one or two depending on what you have in the way your contracts wise, what you do in effect. If you normally just adjusted it and sold that many out there, and on the hope that it's going to do that retrace, you can collect a reasonable premium out here, and then when it retraces, then you get to recover what your potential loss that you were showing from the initial position, and then you gain from the movement decay that occurred because price went to the direction in your direction. Did that make sense?
Yeah, no, 100% makes sense. But you're just hoping that it does rebound and that it doesn't continue in that upside direction.
Right. Yes, but oil does do that. It always seems to go up and then come down and then swings back and forth. Yes, and the hard part is when you get into a condition where, in effect, where you don't know what the heck's going on. In effect, like in this spot, this spot here.
Yeah.
You kind of, ideally, when you're getting in a down and it's really heavy, then the ideal situation is just, in effect, in this case, you buy back your puts and let it go until it, got down here, and then you resell them again when it starts back up again. And in this process,
if you knew that.
Yeah, no, I'm a very excellent trader on the left side of the mark chart wise, but
yeah, right.
You do, if it's, I've got, if this one here, I think I was in, and basically it got to, I think 175 in 2 days, and it was 2 days. I put it on, and then within 2 days it was, down hard. So I just bought back the shorts, and basically took my loss, because you see it as you get into it more, that okay, if I just taken the loss and I could have gotten further out, which I'd have to do on the adjustment wise, and lock in that loss, because I'm going to lock it in anyway on the P&L, and just wait for it to get down lower yet, because if it continues down even one more bar, I can get a better price and not have to readjust again, looking for a spot that it gets down to an area to where I won't have to readjust it, hopefully again, if it change, if it were to, how do I want to say this, looking for a spot that I can put it on that looks like a spot that I won't have to make another adjustment in it, and just sell that
Right.
side again.
Yeah, but that's where the magic is knowing that. So
Yeah,
it's
there's
kind of like, what are you looking at? Are you looking at the long bars? I mean, the area you're showing at has a lot of big down bar days. I mean,
this is a daily chart. Yeah, so we're
I
looking at
realize.
days, not you don't want to. You can make money on the 5 minute chart, but then you have to do a lot more trading. And this
Yeah.
is, but when you drop, if you got in here, if you bought up here at this, in effect at this high, which is 63, and by the time you got down here to 60, it's you got to say, well, that move has taken me to my short side, probably because the IV doesn't give us 10, 15 points to move for it to move in anymore. And when you get in here, at best you're going to have 5 for and that's in effect 3 up and 3 down is what you end up with. So you say if you've gone down 3 from where you got it, so you just take your loss there and then look for a deal. And when pretty much wise, take the chance when it comes back here and maybe takes out that high there, you sell down here at 55.
Okay. So what you are in effect doing then is you are reading the bars, and you are holding your positions. You are not adding to your positions as it's moving down in this particular case, because it's a continual down movement until you back up and take out a highs. Sounds like that's what you're saying.
And then basically it's like this uptrend here. I got in, haven't made any adjustment. I got it. I wrote it. I was able to write it all the way up to this high, which is a new current month's high, for that everybody's then say this thing in September's contracts wise, it started out with about I want to say roughly maybe 60 cents backwardation, and in this move up they've increased the backwardation from 60 cents to $2.25.
Oh.
So that's a saving feature that I haven't had to do any adjustment that I would have had to done, if I was looking at the current month's price, because the current month price we're looking at 72.76 right now, and it's this trade's price is 70.52.
Okay.
And I say earlier on, this is usually contango, where here you'd be looking at the 72 and the current month would be in the 70s.
So when you say the current month, you're displaying the September contract. You mean the June month, or what is the current month?
Current month would be August.
August?
No, take it back.
Okay.
Yeah. Current month is August.
Okay.
August expiration.
All right, August. Okay. But the September is the month that's what are you, about 40 days out now on that?
Yeah, 42 days left to expiration on September.
And then August is what, 30 less than that, probably.
August has got 12.
Yeah, so about 30 less than that. Okay.
Yeah.
All right. So now, are you in the August month?
I'm out of the current month, yes.
Okay, so you got out of that because you made your profit then, is that right?
Correct.
Which is 50% of your original.
Right. Income.
Okay. Okay. As you add to your position by these adjustment techniques we're talking about, do you raise the ante as to what you need to get out of it, or do you stick with your original figure?
I'm pretty much, I'll stick pretty much the original, but usually I'll get at it more.
Okay.
I'll try to, watch it, watch where it's at, and if it's sitting in the center, I'm gonna let it go. But
Yeah.
if it starts moving to one side or the other, I'm gonna be kind of skittish. I don't let it run. I just, I don't let my winner. I let my losers run, but I don't let my winners run.
So,
which is a bad habit you got to get out of.
How close will you go to expiration while you wait to get your 50%?
I usually like to, let's see here. So right now I got it's 64 days until I start September. For me to put on my September trade, which would be the October options.
Okay, that's another how long? How many days?
You got 54 more days before I'm looking to enter the trade.
Oh, wow. That's quite a ways. All right. So is that what you use as a way to determine when to get out of your current trade?
Yeah. If it's sitting perfect, I can put on 2 at one time, but usually I just like to concentrate on one thing at a time and to be one trade only.
Okay. So you say you got about 50, you say 54 days, something like that, for the October, for that one?
Before I work with the October contracts, yeah, it'd be sometime in September.
All right. But this one that you're in now, the CLU 8, that's got less time till expiration, right?
That one's got 42 days, yes.
So this thing is going to be flat and done before you're ready on the October, correct?
Right. Usually, most of the time I'm out in like 17 days, 17 to 22 days.
From the time you go in?
Time to go in, the time I'm out, yeah. And if it's, I have gone to 30, but out of the 50 days to expiration wise, so there's usually still about 20, but you're getting close to where you need the new trade starts usually about 10 to 12 days before the other one would expire.
But this one is going to expire, go flat in, what do we say,
42
days.
Yeah.
And your October isn't ready for another 54, something like that.
Well, okay. It's 54 days to when it's 50 days to expiration.
Yeah. So, meaning you can't, according to your rules, you won't enter it for another 54 days.
Right.
And meanwhile, this one is going to
excuse me, I take that back. I was looking at the wrong month. Okay. My next one goes into play in 24 days.
Oh, okay. That makes so more sense. So is that the October contract then? And in 24 days, we'll be down to 50?
That's the November contracts in October will be down to 50 days and 50.
In 24 days from now.
54 days. That one will be down to 50 days from today, basically into the range where it would be put on. I'd be putting on the October one.
Okay, so you're going to be putting on the October one then before this September one is finished, and you kind of use that
it hasn't expired yet, no, but
right. And at the 50-day point, the October that you're in now will not have, or excuse me, the September will not have expired. But that's when you like to get out of it when you enter the next one.
Right. Yeah. Usually, that's 20. It's 24 days, so there's probably usually going to be about a week.
Okay, so about a week left in it. All right, yeah. So which means your gamble is pretty high at that point.
Yeah.
So let's say that you're not up to 50%. Would you continue to work it?
If it's, in the center, yeah. If it's not, then I just take less profit.
And you just hope it doesn't make a big surge all of a sudden overnight, right?
Yeah. If it does that, okay, then I could be in problem because, then I'd be in problem on the new trade that I started.
Okay. That's real helpful. Then the other question I was going to ask is volatility. Isn't there a volatility indicator specifically for crude? I'm trying to remember what that is.
OVX.
OVX. Okay. Is that?
I mean, that's the biggest thing that's happened here right now. The OVX, the volatility on crude is gone from where was it when I started this thing? I think it was down about 20 in the 26 bracket. Let's see. Is 24 to 26 for the option wise. Those seem to be staying about the same, but the implied volatility of the future was at 24. Now it's up to 28, and OVX basically, was down in the 20, almost say 26 bracket when I started this thing, and now it's up to 34. So that's
okay. So
I'm making profit now, but I'm not making much. It could just because they bumped up the IV on me.
Okay, so I'm looking at the OVX now, and I'm showing the OVX is showing about 29.0. Is that, you agree
right.
with that?
Yeah.
Now that's on the future or on the options? I think, don't they have a different one for the options?
That's the futures contract. That's oil. That's oil's volatility contract
okay.
level. The future right now is at 28.13. Option wise is based a lot of how to say this, but I mean it depends on where it's at, because that's one of the things I feel that these guys use for pricing, because the current if you look at the 51 and a half put, it's got a volatility of 38.24 and its value is 2 cents.
Oh, yeah.
So, and if you look at the 66 and a half, it's got an IV of 27.64 and it's got a value of 90 cents or 98 cents. I mean, it's so the option volatility is different than the future volatility, but they're kind of similar, but they're, let's say, the actual formula that the market makers use to calculate the price of the value of an option is they've got the volatility of the future, the volatility of option that's calculated, the probability that it's going to be in the money, out of the money, or even touching it. All that stuff is there, and then if they see down the line there somebody posts up that they put out a big buy or a big sell order, then they get this extra fudge factor in here that plus up in the spread between the bid and ask to cover, they basically cover their tails, and so they make money.
Right. So, and like I was telling you, when I did this years ago, a lot of uncertainty came into the market and the volatility went way up. And what happens, of course, is your position starts losing money because your liability on your options, the option values go up. And I'm scrolling back when I'm looking at last year. October was a low of right around 32, and it spiked all the way up to like 50 in about a month's time. And if someone was short options, like what we're talking about, that could really go against you.
Yeah, no, as I say, this one here, they started it on the 27th of June, and in that time period has gone against me in the volatility aspect, so that I haven't gotten much in the way of time decay.
Yeah,
I don't really have a week's worth of time decay here, because if I did, I'd be up maybe pushing $1,000, but IV has gone up basically 6 points in that time period.
Yeah. So I guess my other question then is, do you look at the IV before you put on a position, and does that affect at all any of your actions in placing positions?
Ideally, I like to have it high, but in this case here, it was the day to do it, so I did it.
Yeah.
I mean, the ideal thing is, you wait for an IV like today. Well, at the end of June I would have waited had I known it was going to do that. But it's another right-hand side chart.
Yeah. Yep.
I don't know what these guys. Anyway, we're up basically 44 cents today, and this is one of the lower volume days that bounced across this place in a while.
Yeah.
I mean, it looks like technically looking since the day should have been oil report day. I haven't looked at the what I want to call it. what the heck's the name? I can't even think of the friggin' name of the company now. Forex Factory.
Forex Factory.
Yeah. Crude oil. Yeah. At 11 o'clock it reported oil capacity went up 1.2 million. They were expecting a minus 4.4.
Oh.
And the market just said, well, so what? I mean, yeah, if you look at the 5-minute chart.
Yeah.
Okay, so here's, all right, 10:30, 11 o'clock it got reported. Okay, so it dropped from 71 to 70, 53, maybe a buck in 5 minutes, and it regained it, and now we're proceeding to go close. While we closed out the day here, let's see who's lowest. 36, 35. So again, at 240, at 225, basically 230. The 230 bar was the lowest bar of the day, trading day.
2:30. What Eastern time?
Yeah. Excuse me.
2:30. Okay, so that's 11:30 my time. Okay. Yeah, I show 70.35 as the lowest on the September contract. Yeah. So, all right. Well, look, I don't want to dominate the whole session. I really appreciate.
No, that's good.
You're giving me encouragement to get back in. Are you at all available email during the week or?
Yeah. Probably better use rwrose@298 @gmail.
rwrose298?
Yeah.
@gmail.com. Okay.
Right. Where are you located at since you're Pacific?
I'm in California. Yeah, San Clemente, California.
Oh, you're down south. Okay.
Yeah. So, are you Pacific time zone yourself, or are you?
Yeah, San Francisco.
You're just same time zone. Okay.
Yeah, just up the state, up in the smoke.
Okay. Well, very helpful to latch on to somebody. Like I say, I really got my head handed to me several years ago when the volatility just took off, and I just lost a lot of money. And it just
I think I might know the one you're talking about because I did the same thing. I didn't catch the waterfall fast enough to, as I say, when I back tested this thing, found out that every time it did a waterfall picture on a chart and going, those were losers. And so your best deal is, sit back on the sideline and let the blood flow. And I didn't that's basically when it went down to like 40 from I think in the 70s down to the 42 bracket.
Yeah, I think that's probably right. And human nature is we hang in there trying to make back what we lost, right?
Yeah, well, I say that's if you take a hit, start over again. You know, as size wise, start small and build back up. But that one there, as it turned out, that was when Citibank decided they no longer wanted to deal in futures. So that's, I guess, that was the cause of that. You know, partial cause of that particular down trip. So these banks and brokerage houses we don't get to see their game plan. I mean, it's like looking at bar. You have to kind of watch the bars, and hopefully you can get some inclination of what the major players are doing. It's if you're in the stock market, if you watch them, you can find out when the mutual funds and those guys are buying stuff because they buy quantity wise, and they'll make a big bar, and they'll make a big bar, and then the next day it'll be a small one, and then there'll be another big bar, and when you catch those, you can ride it up on their money, which is basically all you do. You follow the path of the elephant when he goes through the forest, and you want to stay as close to his tail as you can. So you get as much space in the trail at the time of breaking time, but I mean,
yeah.
I can't see some of the reasoning for some of these swings that we're getting into, and I say that it appears that the volume in oil in the marketplace is kind of slowing up here since school's gotten out and people seem to be going on vacation. But so some of the bigger players are kind of taking it, not worrying about what oil does, and they probably won't be back until November, December contracts, and then I'll be watch your back.
Oh no, yeah. Well, you may have heard Trump made a big push to the OPEC countries to back off. Maybe that has an effect. I don't know.
I thought I heard one time he wants them to produce more, but I don't know.
Yeah, that's what I meant. Yeah. Because it build up too much. Yeah.
But the oil companies, they would like to have that, but say the frackers aren't going to let that happen. They want it to keep up there so they can make more money as they frack it.
That's right.
Whether they're doing as good or bad, I don't know for sure yet, because if it's anything like PG&E, at times when they're doing their stuff and they gets into the water table that we have to drink, then or we get our water supply from, it gets kind of lethal.
Yeah.
And they don't want to admit any of that stuff that we couldn't do anything like that. We would never start a forest fire by having our wires arc. Near a batch of trees that we should have buried the cables 50 years ago. It's cheaper to string it from pole to pole and let the air cool it, that type of stuff. But say the countryside looks a lot better without wires hanging around.
Yeah, for sure.
Yeah. All right, I think that's all for me. If you haven't got any more, then I guess we could call it a day. Hopefully everybody learned something today.
That was great for me. I hope I didn't hog too much time.
No, that's what I like to hear, and try to help out as much as I can. I say I've been good. Oil's been great to me, so I'd like to keep it that way.
Okay.
And if I get more people interested in it, maybe we can all make some money instead of the chosen few.
I plan to work with just one contract and kind of maybe work with the 1.75 mark that we discussed here.
Yeah. Okay. Good.
So,
Yeah,
it goes.
work on a trading plan. Just figure it. Write it down what you plan on doing, and then stick to it. That's the hardest part.
I know. And here is one last question, Rick, and that is, do you ever consider rolling your unthreatened side in closer?
I have done that. Yes. Just basically looking to, especially if it's in a wild up move or down move type situation. Fact is, there's occasion wise, if it looks like it, going back to that one reference that I think you and I were both in, there's one time that I accidentally sold I forget, it's 70 or 80 calls which was at the money.
Ooh.
And
yeah.
And then I turned around and I forget what I did, but had I left that trade alone, I'd have made money. I'd have made bunches of money because I think since it was at the money, it was an at the money deal, and price was moving away. So, what better thing do you want?
Yeah, so you couldn't resist it. Yeah.
Well, I closed it before. I think I made maybe $1,000 in probably 30 seconds on the thing, but it's one of those things that you could have sat there, had that there, and let it expire worthless, and made. I think the potential was like 80,000 or something like that. But
yeah,
it's one of those things that you having the knowledge, intestinal fortitude, and confidence in your decision is the biggest thing you have to get into. So it's a philosophical thing, I think, or maybe I'm wrong on that, or psychological at least.
Yeah, we are.
Yeah. Go ahead.
We're emotional people. And that's like you say, make a trading plan and stick to it.
Yeah.
How you guard against your emotions swaying you in the wrong direction. And, it's such a temptation to roll up the unthreatened side to start making more money out of it. And I'm not sure if that tests out as a good thing to do or not.
Yeah, especially, I think I tried that one time that I rolled. I had a short position that had basically gone down to like 8 or 9 cents. So I in effect closed that one and added another one. Turned out to get any money, to get something reasonable, I had to go up like about 5 points to make 60 cents.
Yeah.
And at that point, then Price decided, hey, he's rolled it up. Now let's go get him. And yep, that 60 cents went up to, within a couple of days, it made $1.02 move, and that 60 cents went to $1. So it's stuff like that. That's why I like to. That's why I like to get $1 for these things, because it's a small move when you sell it cheap. A small move can hurt you bad. Where if you get $1, it's not. It seems to take a little more movement to get you into Dutch.
Wow.
That's my findings. I'm more comfortable with $1, and instead of having a 50-cent move on 60 cents, I get a 50-cent move on a dollar. So now it's $1.50 instead of double what I got for it. So initially, so I rather, that sounds better to me.
Yeah.
But they say oil, if you got enough money, you can make money. I This is a long time ago. I think Apple was at 72, and I noticed somebody sold. I'm assuming sold. Oh, something like about 40,000 contracts at 5 cents a contract, which is ended up being about it was 72, I think maybe $59 or $49. And so here's maybe it was only 10,000 contracts, but either way, the guy was looking to make roughly $50,000, and it was pretty much a guaranteed deal at expiration. I mean, for Apple to drop from 72 to 49 in X number of days was, even though it did get down to 14 after that, but it didn't make it that month. I think that month it got maybe down to 69, but so he brought in like $50,000, but it's been nice to have that type of money to do that.
Yeah. Well, that's true.
Okay, so I guess we can call it a day. And catch everybody next week.
Okay, I look forward to it.
All right.
We'll see how it goes.
Yeah.
Thanks.
Take care. You too, Mark. Have a good time. Hope you had a good 4th of July.